I'm glad that you're all here, that I can see you in person, and I hope that this augurs well for the future for us, both you and our firm. Let me go into some preliminary remarks. For many of our clients, bonds are the unsexiest part of their portfolio. They believe all you do is buy them, collect your income each year, and get paid back when the bonds mature. If interest rates to the market rise, some believe your existing positions aren't affected, while others think it benefits your holdings. And some of you really know that that's not the case, so I'm not telling you that they're all like this. The real story is when interest rates rise, you lose. Your bond is worth less money because your contract generally calls for you to receive a fixed annual sum, rain or shine, and higher interest rates to the market make your yearly cash payments less valuable. The good part of the story is in the past, actually. Well, at least in part. It is that rates have been rising, can you believe it, for 40 plus years, and on balance. And so your bond price have generally gone up each year. The bad part of the story is that the Federal Reserve's actions to deal with inflation have tended to have resulted in a sharp increase in interest rates this year. The resulting decline in bond values has not allowed bonds to offer the great safety it has generally provided for your more volatile stock holdings. In fact, the loss of about 15% year to date, last time I looked at it, is the largest in the history of bonds. I wouldn't get too excited over it, but it is a meaningful figure. Our firm has on balance done better than average by, until recently, emphasizing lower maturity bonds. There is a potential favorable ending to the story. The higher income on new purchases of bonds, especially as compared with puny, you like that word? Puny rates less than a year ago, gives you an income cushion and makes bonds a real competitor for stocks. For the first time in many years. In some, bonds are worth thinking about now, and that is the reason why we asked our guest, who is eminently qualified to come to speak to us tonight. Kathy Jones is Managing Director and Chief Financial and Chief Fixed Income Strategist in the Schwab Center for Financial Research. She's responsible for interest rates and currency analysis and fixed income workings for Schwab clients and the public. Previous positions were as a bond strategist for Morgan Stanley and as Executive Vice President for the Debt Capital Markets Division for Prudential markets. I know it was just a coincidence, but about a week ago, Kathy was prominently quoted in a New York Times article that was in some ways very close to our topic tonight. Please welcome Kathy Jones.
Thank you. Thank you, everyone. Thanks. So should I take it away now, Lou, and talk about the terrible bond market that we've seen?
Let it all hang out.
Okay. So yeah, it's been a bad year, as Lou has pointed out. The aggregate bond index, which is what the bond world uses similar to the S&P 500, is down about 14.5% year to date. That is a miserable performance and very unusual. And the reason is we've had what we're calling like the great reset in interest rates. So if you think back to the end of last year, which I know seems like a million years ago, but it was only about 10 months ago, we still had near zero short-term interest rates. The Federal Reserve was talking about raising interest rates because inflation was bubbling up and the economy was doing better. And then they started to raise them at what at the beginning was sort of a gradual pace. But then, the war in Ukraine sent energy prices sky high. We had a second fiscal stimulus package which boosted the economy at a time that drove demand up when we still were having problems getting supply. And inflation is just, in our book, a difference between supply and demand. Too much money chasing too few goods is what we used to call it when I was in school. That was the Pleistocene age, but it's still true. And so we had this imbalance. And so the Federal Reserve did what their central banks are supposed to do and said, okay, we're going to start raising rates. We can't control the supply side. That has to work itself out with supply chain problems, energy prices, you name it, but we can do something about the demand side. And unfortunately, the demand side is if we raise interest rates a lot, people can't afford stuff and they spend less. So that's what we're sort of in the middle of. It's normally, this kind of a cycle is modest because you're not starting at zero and have the highest inflation in 30 years. This is where we find ourselves, and this is why we've had this massive move. The good news is we think that much of the worst is behind us in terms of interest rate hikes. The Federal Reserve is talking about a couple more. Currently, their base lending rate is about 3.25%. They're talking about going to 4 to 4.5%. The market's already priced that in. The market already has that out there. So if you look at a 2-year Treasury note, it's over 4% right now as we speak. So it's already saying this is where we're going. So that's the good news because it's priced in. The second good news is that I think they're wrong, and I don't think they're going to go to 4.5%. Now there's a kind of negative story to this, and this negative story is there's a lagged effect from these rate hikes. It's been so fast and so furious. It's actually the fastest rate of change we've seen in modern times that it takes about a year for it to work through. It's only been 10 months. And so as we get in towards the end of the year and into next year, we'll probably see the economy really slow down. We'll start to see inflation come down. And I think the Federal Reserve will say, we were too late to start, and now we've gone too far, and they'll probably have to reverse course, probably early next year. A lot of complicating factors in there. We don't know what the war in Ukraine is going to do. We have energy price issues that are still popping up from here and there. So it's not a guarantee, but we're also seeing there's a third mandate that the Fed has. So the first one is to keep inflation down. The second one is to try to keep employment as strong as they possibly can. And then there's a third that's sort of unspoken, and that is financial stability. And recently we've seen a lot of financial instability, and that is especially in the global markets. And it's been bad enough here. It's been much worse elsewhere. So you look at Britain, some of that's a self-inflicted wound that they're going through right now, but their bond market has been in tremendous turmoil. Their pension funds having to adjust to this rapid increase in interest rates at a time when they have basically an energy crisis happening at home. Europe is going through something similar. And when markets get extremely volatile and you don't have enough transactions taking place in safe assets, you get this major volatility and these price swings. It feeds through to what the Federal Reserve and other central banks call financial stability. They worry if you can't transact in the Treasury market at a normal pace, in a normal way, there's no liquidity. And we're seeing hints of this. And when you start to see hints of this, this is when central bankers kind of go, oh, wait a minute, this is not good. Today, Janet Yellen, Treasury Secretary, said something, kind of slipped in there. She said, we're a little bit worried about the liquidity in the Treasury market. Okay, that should be like blinking red lights, you know. Hello, children, this is your warning. Yeah. We've got, hello, Jerome Powell over at the Fed. You guys gotta get it under control here because we're having trouble if we can't fund our activities in a safe market, in the world's safest market. The other aspect of this is international. So we've had a huge rise in the dollar, and that's been a function of the Fed raising interest rates so sharply. That draws in capital. You know, people can invest in safe assets in the U.S. for 4%. That's going to happen all day long if you're in the global markets, right? So what's happened is the dollar's gone up. Yoo-hoo for us, that's great. We export inflation to our trading partners. So it slows our economy down because our exports are less competitive, but it also means our purchasing power has gone up. Every dollar buys more from Germany, from China, whatever. And so it helps hold down our inflation, but we push it on our trading partners. Well, at some point they say, you know, no, this is not good for us, right? And so I think we're reaching points where the rate of change has been so fast. We're creating instability, and we're getting that pushback. And I will just tell you, in the bond market, I follow an index which I actually participated in creating back in the 90s that calculates the volatility in the Treasury market. And it is currently as high as it's been in almost every financial crisis. I hate to use the word crisis, but emergency that we've had in the past. Yeah, it's not quite a crisis yet. But it would imply the change in a 10-year yield is on average right now 9 to 10 basis points a day. Take my word for it, that's a whole lot. So in my book, I think we're getting to the point where it's starting to bite, and it's time then for them to slow down. Not saying they're going to stop, but to slow down. What does that mean for an investor? In our book, it's time to start looking at bonds. Safe bonds, high quality bonds, not junk bonds or some of those other things that are highly volatile. But it's time to look at safer bonds because you can lock in now yields of 5% plus in a high quality bond portfolio without taking a huge amount of risk. And for people putting together, you know, a retirement portfolio, that's a nice base. And we haven't had that base for a really, really long time. So we're actually pretty optimistic that much of the bad news is behind us. Probably going to be turbulent for a little while here. And I think then we start to shift gears and bond yields start to come down and bond prices come back. And then one more thing I'll throw in before we go to questions is we did a little exercise this week and said, well, to get another 14% decline in the bond market, how high would yields have to go next year from here? They'd have to go to 9.5%. Now, I know some doom and gloomers. I don't know anybody calling for 9.5% Treasury yields. So very unlikely to repeat. If we just stay where we are, we'll probably have positive returns next year. secret to being a bond strategist is your projected return in a bond is your yield to maturity. So I can save you all graduate school right now. If you buy a bond that's going to yield 5.2% in 5 years, pretty much can count on your expected return is 5.2%. And that's the nice thing about bonds. You can actually project that forward with a fair amount of confidence. And with that, I'm happy to have a conversation about it.
Well, I think that's very forthright. And let me see if I can build on that. How do you feel about international bonds? You don't feel this is not the time?
Yeah, in the international space, it's been difficult because you have to make money relative to staying in domestic bonds, you need the currency to move in your favor, as well as having an attractive yield. And we've been in a world where U.S. yield is puny. I think that's your word, right? As puny as
very good
they were. I was listening. So as puny as they were actually higher than in much of the rest of the world. So Japan has had zero interest rates for most of my career. Europe actually had negative interest rates for a while. They're positive now. There really weren't a lot of places you could go and get more yield. And then you had the disadvantage of a declining currency. So they haven't looked real attractive. I think there will come a point where they do look attractive when the dollar starts to come down and their yields kind of come up. But I don't think we're quite there yet.
All right. You're pretty excited. Maybe that's pulling you a little farther than you want to go. But what role should bonds play in an investment portfolio today?
Yeah, and this is the excitement for a bond strategist. Okay, this is like the Super Bowl, right? Because stuff's happening. Everybody wants to talk to you. It's been years. So, I am excited. For us, so we have sort of a long-term perspective, which I think is consistent with yours, is that there's a role for bonds in a portfolio, and typically in stabilizing, producing income. So for us, it's really four things. It's capital preservation. So barring a default, you get your principal back and you get your interest payments on a timely basis. That's not true of every investment. Now, they don't have a lot of upside the way, say, a stock does. But on the other hand, you know predictably what you can get. So for capital preservation purposes, bonds usually, barring a default, you're going to preserve your capital. The second thing is generating income. And for a long time, we haven't had a lot of income, but now we do. So you have this base of income to look forward to that you can use as part of your overall portfolio, especially as you move into retirement. The third thing is diversification from stocks. Now, it hasn't worked very well this year, but now that we have a starting positive yield, we think we go back to having that basic diversification. People always say to me, well, they didn't work this year, so let's throw out diversification. I'm like, well, 1 year out of, 500 is not usually a good sample size, or say 1 year out of 50 even, is not a good kind of odds for assessing it. So we think that diversification, certainly with positive coupon yields, comes back. And then the final is just a planning tool. There's not a lot of investments that you can make where you kind of have a certainty about the timing of your return. So when we look at portfolios, we say, well, what do you need? When you need your money? How often do you need it? When do you need it? And with bonds, we can sort of plot that out and say, okay, 2 years in the future, we know we have X amount of income coming in on a pretty regular basis. So it's less about the capital gain, although you can make capital gains. It's more about the timing and the certainty and the income generation that we use bonds in portfolios for.
Good. What should we be doing today? Should we be buying steadily? Should we be grabbing in bonds, or should we be looking for inflation to come down and that helping things, and if so, over what period of time?
Yeah, the crystal ball question. We think you should be gradually moving into bonds at a higher allocation or longer term, because we think there is an opportunity here to lock in some yields that may not be with us. If the Federal Reserve achieves its goal, and I don't know why it wouldn't, then we're going to see lower inflation down the road, and that's going to lift bond prices. It may be a painful process getting there. We may have higher unemployment. I think that's probably likely. We may have a soft economy for a while longer, and it may get softer. But if a central bank in a developed country that's independent wants to get inflation down, it can do it. It's just at a cost. And so we think that now that they've told us this is the goal, then I think that we can look forward to lower inflation. That should help with bonds. Bond yields will come down. That's why we think you should start gradually adding now, so that you lock in some of the yields that may not be available in a couple of years. We never sort of say, oh, all in. I wish I could pick the top of the market and the lows in the market, but I'm pretty decent at my job. I'm not that good. So we like to average out, spread our risk out over time.
Okay. Here's a question that is actually one that I didn't make up. It was submitted, but I like it. And for many of you who are big worriers, we have a lot to worry about, right? It's not only in the business market that we have to worry, the economy. So I'm going to ask you, what is the thing that you worry about most?
Oh, well, so bond people are classic glass half empty people. So the reason there's two reasons I went into bonds. One is because I love math, and it's all about the math. I'm not and the second is I'm a born skeptic. So my father used to say, you were born old. But, I was like, I never really believed in Santa Claus. It's like, that doesn't make sense, right? So I think if you're...
My mother told me that too.
Yeah, there you go. That doesn't make sense, right? That's like, I'd look at the chimney and say, there's no way that guy's getting down there, right? So, but it didn't mean I didn't enjoy Christmas. It just didn't believe in Santa Claus and the reindeer and everything. So anyway, I think to be an equity person, you have to kind of love the story and be the excitement and kind of get caught up in all that, and I never have been that person. So, but with bonds, you're kind of like, what's my bottom line? It's like, what can I afford to lose? And so when I look at the world right now, I just see so many, we've just sort of careened from one crisis to another. So we've had everything from the start of the financial crisis to now we have the war in Ukraine. Some people aren't as excited about bonds as I am. But, we've had the war in Ukraine, we've had the energy price, now we have OPEC saying that they're going to try to keep oil prices higher. We've had just any number of one thing after another. And so what I worry about is our ability to keep bouncing back, right? The resiliency. I think we have it, but I do worry that we're kind of getting fatigue and the confidence about bouncing back. So if I worry about anything, it's just that we've had such an extended period here, and I want to kind of see this sort of national confidence grow, and I think I worry that I'm noticing a lot of fatigue. The second thing I worry about is just a potential problem in the markets created by this abrupt shift. So there's an old saying that says when the Fed raises rates, when the Fed tightens, something breaks. And the most fragile thing breaks first. And we're sort of seeing a few cracks here in emerging markets and our relationships, with our trading partners. We're facing, kind of conflict with China. We've got Europe Can they stick together in this environment with the energy crisis? Britain's just, kind of doing its own thing there. And so I worry a little bit about, are there underlying cracks developing that we're not aware of? Because there's so much happening up here. And I worry there's too much leverage in certain parts of the markets. Always hard to put your finger on. You don't know until it happens, unfortunately. But I worry that with the low interest rates we've had for a long time, you can build up some of these imbalances. And I think about those a lot. I don't have the answers.
All right, so before I open it up, I'm going to open it up after this question, but we're talking gloom and doom. What are things that make you feel optimistic?
Yeah, no, I actually, so I may be glass half empty, but I actually am optimistic that we have a lot of very solid institutions in place. So banking sector, they're not happy that they're highly regulated and well capitalized, but they have to be now. So the chances of us repeating a banking crisis, very, very low. And I feel that has actually been spread. There have been a lot of international agreements to make sure the banking and financial sector is in sound shape. So I feel very optimistic about our ability to handle anything that comes along. So I'm very optimistic about that. And I'm sort of, so one of my former employees is working here at Altfest now.
Yes.
And
hit the ground running.
Yeah, and don't tell her, but she's phenomenal, right? And I think this generation is coming up. Every generation kind of has its characteristics. This one's very energetic, very smart, very energetic, and very capable. And I think as we kind of segue into them coming up and getting their hands on things, I have a lot of confidence that they're going to be able to do it. So I'm a long-term optimist, just a lot of nervousness right now.
Okay, John.
Good. Kathy, we're going to start off with the first question, which is for you, which is, what is the maturity that you find the most attractive right now? 2-year, 5-year, 10-year?
Yeah, so maturities of bonds. I think we try not to pick one maturity simply because it really depends on your situation. So for some people, it might make sense to be in a 5-year bond. For some others, it might be 20 years. When we look at sort of the biggest return for the risk that you take, the duration risk that you take, we're kind of in that 5 to 7 year area right now, where you kind of see the peak in yields relative to where we see the duration risk. But that, again, high quality bonds. So, but again, my preference is always to parcel it out over time and not try to guess the exact, put all your dice in, one, but no, it's not dice, what is it? All your chips. You say I don't gamble. All your chips on red, right? 5 year, this is it. I like to spread them out a little bit.
Thanks, Kathy. Lou, we're going to come to you for a minute here. And the question is, in what areas of the market, which sectors do you find most attractive right now?
Well, in the bond area, I like non-agency, I should say, bonds with short calls, because you're not going to get much fluctuation, and you can get rates of return, pre-tax equivalent rates that are close to 7% for many people. So I like that as a bailiwick. I like, as a value player, I like the foreign part of the market. I don't see so many problems, foreign meaning not European, but the Far East, and in China, just hold to the big companies that have strong, the technology companies with strong positions, which are very cheap right now, but then taking a broad-based view of other markets. I just like the way they handled things and their emphasis on education, on working hard, and they're not getting hurt as badly as the Europeans are. And when we look over this period with valuations that are half, in some cases, half that of the United States, that when these things reverse, because there have been times when they've sold at significant premiums, you're going to make a lot of money. And for that reason, we are overweighted. We still have, don't worry, we still have over 50% in U.S., but we have a very strong position in that market.
Okay. Good, thanks, Lou. One more question here, but of a different flavor. But how do you expect interest rates to affect the real estate market?
That's a tough question in a way, because you have two factors. On the one factor is higher interest rates is going to make people be constrained from buying homes. And on the other hand, you get an inflation hedge in the value of real estate. And how these two play out this time can be difficult. But at the valuations that we have in Arden Realty, they're, he threw out, Andrew threw out some thoughts. You know what you're talking about in a bad year, that he's projecting 20% returns? The exact opposite. It's got a plus sign in front of it instead of a minus. That's why we got involved with this. And I'm going to tell you a quick story. You may believe it, maybe you're cynical, you don't believe it. But he came to me, Andrew came to me and said, I'm doing well. I've encouraged him. He was interested in bonds and bought him, in real estate. And we bought him for his own account. And he said, this is working out. Maybe we should keep this for the family. I said, we have a fiduciary duty to put our clients first. He asked the question. He didn't say. So he knew the situation. And so that's what we've done. We could have made more money by just keeping it in-house. Instead, we have people running all over the place for to go into these auctions. So we like that. We like it for the inflation hedge, and we like it for just for its fundamentals. And we think that we continue, we call it a projected return, but we've bought them at the right price. So that is going to put us a mile ahead.
Good. Well, that just about wraps it up for the Q&A session.